Good day, everyone. My name is David Williams, Executive Director of the International Association for Energy Economics. It gives me great pleasure to welcome you to today's webinar entitled The Oil Downturn, Implications for the Energy Transition. We are grateful to Dr. Roberto Aguilera from Curtin University and our distinguished speaker for today's timely discussion. First, a little bit about the International Association for Energy Economics. We are the largest association specializing in the field of energy economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations along with a host of other products and services that you can find on our website at www.iaee.org. If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our moderator. First, this webinar is being recorded for those that cannot participate in today's live event. If you have questions for our panelists, please click the Q&A button at the bottom of your Zoom window and type your question. We've allocated sufficient time at the end of this webinar to address your questions. And now I would like to introduce you to our moderator and speaker, Dr. Roberto Aguilera, energy economist at Curtin University Oil and Gas Innovation Center in Australia. Roberto, over to you.
Terrific. Thank you very much, David, for the introduction and for inviting us to participate in this IAEE webinar. Thank you also to the audience for attending. As mentioned, we're discussing today the oil downturn and what it could mean for an energy transition. So the way it'll work is that I will first give an introductory presentation lasting 10 minutes that will cover market developments in the recent past and also future prospects. We'll then move to the main presentation by Mariana Liakopoulou. Mariana is a research fellow in energy security with the NATO Association of Canada. And she will be presenting about the implications of oil market developments on the growth of renewable energies. So her presentation will take around 25 minutes. After that, we'll move to the question and answer period. So I encourage you to submit your questions in the Q&A box, and we'll attempt to address those at the end. So I'm going to now share my screen where I have my PowerPoint loaded. Here we go. And I'll move right away to the presentation outline. To begin with, I'll go over recent oil price trends over the past couple of years. There's been a fair amount of fluctuation over that time. Of course, 2020 has been a story of its own. Then I turn to the major drivers of the market from the demand and supply side, and I give my expectations generally about what can be expected for price in the future. And then I'll close with my views about the role of oil in the long-term energy mix. So here we see a price figure going back to the year 2017, and you can see that movement is generally between $40 and $80 a barrel. In 2020, obviously the most disruptive event was the COVID pandemic, which devastated the global economy, and with that, oil and gas consumption plummeted, and so did the prices of these commodities. But with economies starting to open up, it follows that petroleum consumption is rising as well, and it could rise back to somewhat normal levels within a year or so. Already this has helped to push the price of oil, for example, above $40 a barrel, and that's offering some relief to the industry. Going forward, there is uncertainty about the direction in which prices will move. I have here some downside factors for the price. For example, additional COVID waves, which is happening in some parts of the world. Also, there are signs, again, of trade disputes between the US and China. On the other hand, there have also been signals of a trade agreement. But anyway, on the supply side, if major producers like OPEC and Russia raise their supply quicker than expected, or if the shale sector or the industry in the rest of the world proves to be resilient, as it has in past downturns, then all of this, of course, results in additional downward price pressure. Here are some upside factors. First of all, if the COVID pandemic is properly contained and a vaccine developed, then it would lead to a so-called V-shaped economic rebound. On the supply side, there are fears about geopolitical disruptions in some important producing nations. And in terms of OPEC plus policy, if they do keep these steep cuts maintained for a long period, of course, that'll help to boost the price. Finally, if the industry around the world is hit hard, whether we're talking Canada with the oil sands or the shale sector or offshore South America, North Sea, Asia, then all of this too will raise prices. There's some headlines here in the next slide, and they're all over the map. The Jpmorgan forecast was, in fact, for the year 2025, and that would be the result of the capital expenditure declines seen today. And meanwhile, consumption is expected to keep rising steadily over the years. So in the end, it would result in $190 a barrel. At the bottom, the US Commodity Futures Trading Commission wasn't actually predicting negative prices, just saying that we should be prepared in case that happens again. So there's more than meets the eye in these stories, but sometimes the journalists prefer these juicier headlines. It sort of leaves us with the impression that nobody really knows what will happen, and it's very difficult to predict oil prices. Here is a forecast from the US Energy Information Administration. And most organizations concur that starting from the second half of this year, world consumption will exceed production. And that undersupplied market therefore implies stock draws, which generally suggest rising prices ahead. And I want to make one more point about the relationship between price and shale oil in particular. Although there have been many other technological advancements in this industry over the past century, for example, the tapping of deep offshore fields, advances in seismic, and so on, there's a vast difference between that continuous change and the development seen in the shale industry. The major difference is the very quick reaction time associated with shale, which means speedy production responses to changes in the price. For other sources of oil, it was taking around 5 to 10 years after an investment for the production to come on stream, for example, from oil sands or offshore or conventional oil. But in the case of shale, it's been observed over the past decade that with rises and falls in the oil price, the drilling rigs become active or inactive in the case of a price fall in just a few months, and then production responds maybe 6 months after the price change. So these relatively quick production reactions, of course, then have implications for the price. We have a long-run supply curve here showing tight and shale oil. But if you were to look at the projects around the world expected to come on stream over the next 5 years, most of those, around 75%, are expected from the US shale sector. And they have average break-even production costs of $40 to $60 a barrel. So if there are large amounts of oil at the $40 to $60 level, it will help ensure that price settles at that level, which makes sense. If price goes above that, then of course production is very profitable, and once that supply comes online, it pushes the price back down. If the price then falls below the $40 to $60 cost, then a downturn could result. Producers exit the industry, and the supply fallback will push prices back up. So price will fluctuate around that 40 to 60 average break-even cost. Moving now to the energy mix, this shows the historical mix and a projection to the year 2035. These are just the fractional contributions of each energy resource. For example, the oil share peaked in the 1970s, though consumption and production of oil in barrels continues to rise today, so it's just the market share that peaked. Also, you see the rapid penetration of natural gas into the market, which is based on its many advantages like its abundance, its affordability, its wide geographical distribution, and its environmental benefits, at least compared with the other fossil fuels. If we just take the oil consumption from that model, this time in barrels, we had a projection in the year 2007, which has proven fairly accurate when compared with the stats of the last decade and a half or so. Those are the red dots. Though, of course, this was all done way before the pandemic. So now there's a lot more uncertainty. Here you see an article highlighting a projection or a forecast by the consultancy DNVGL, who thought oil demand might have peaked in 2019. That has generally been discredited because as economies bounce back, then it stands to reason that industrial activity, transportation, trade will all come back too, and oil demand should rise. Still, peak oil demand has been a popular topic in recent years, and there's a wide range of views on when oil consumption could reach a maximum. Even some oil and gas companies, particularly some of the European ones, see the peak coming sooner, as soon as the mid-2020s, and they even speak publicly about it at times and have made some adjustment to their investment portfolios to accommodate a greater emphasis on gas and renewables. So far, though, as we know, there's no large-scale substitute for oil in its major end use of road transportation. Also, the petrochemical sector represents a strong source of growth in the coming decades. But if there were to be implementation of an ambitious climate policy or a technological breakthrough in electric vehicles, then that could slow oil demand down considerably. That takes me to the conclusions. The most recent downturn has many believing that the transition to renewables will be accelerated. We had a price forecast of $40 to $60 a barrel for the coming decades, though this year the oil industry is nowhere back near to normal after the chaos experienced earlier this year. So the implications of all this for the energy transition are yet to be determined. And that is the subject of the next presentation, to be given by Mariana. And so at this stage, I will now turn it over to you. Thanks, Mariana.
Thanks a lot, Roberto. Let me just share my screen. Okay, so now you should be able to view my slides, right? Great. So thanks a lot. And picking up from where you left off, excuse me, seems that I cannot move to my next slide for some reason. I don't know why is that.
Hi, Mariana.
David?
This is David Williams.
Yeah.
Have you by chance sent your PowerPoint deck to Rebecca that we could scroll through for you or to me?
No, actually, I haven't. Well, let me just try this.
Alternatively, you could show it in not slideshow view. And
Yeah. I will just try this one now. Excuse me. Sorry for this interruption.
No problem.
Okay.
There it is.
You see that?
Yeah, now I can move to my next slide. That's great. So sorry for this interruption. Well, as I was saying, picking up from where you just left it off, tightening fundamentals set against a weak macroeconomic background have kept oil prices stuck in a narrow trading edge for most of the first half of 2020. From January to April, COVID-associated restrictions have led to an oil demand drop of approximately 25 to 30 million barrels per day. So the aim of this presentation is to determine the extent to which this immutable, as it seems, market narrative could accelerate the deployment of clean energy strategies at the distinct but mutually reinforcing state and industry levels. The International Energy Agency forecasts a decline in CO2 emissions by a record of 8%, which is down to a decade low and is attributed to the impact of the bans on non-essential movement and worldwide curfews on global energy demand. It also projects a 40% share of low-carbon technologies in the global power mix, partly due to an estimated 5% decline in overall generation. During the first and second quarters of 2020, renewable generation picked up in almost all major economies under lockdown due to the scale down of coal and gas-fired generation. However, no matter how low oil and gas prices go, they have a hard time competing with wind and solar's short-term costs in the generation merit order. Wind and solar are zero marginal cost producers. Once you put them on, producing additional energy is free, whereas with coal and gas, there's always a price to be paid for the fuel. In a context of suppressed electricity demand, generators seek low operating costs, which is something that renewables can offer. Therefore, the most expensive marginal producers are the ones getting hit, whereas renewables remain immune because policymakers will give them priority dispatch into the grid to the benefit of consumers. Moreover, this oil collapse has coincided with a period of increased renewable capacity, driven by already commissioned projects, as well as a boost in overall clean energy financing over 2019, as well as by the continuous cost competitiveness in onshore wind, solar PV, and battery storage. However, renewable installations are set for a 13% decline in 2020 because the global economic recession will likely reduce demand for more solar and wind development, thus limiting the availability of tax equity finance. The hardest hit sector is going to be solar, because lockdowns and strained household budgets are going to avert small businesses from investing in those rooftop solar PV projects that they might have planned to do at the start of the year. However, renewables deployment is expected to rebound and perhaps reach pre-pandemic growth in 2021. The first section of this presentation aims to discuss the outlook for world power's decarbonization agendas and global climate diplomacy, with lower for longer as the new normal in the global oil order, and with economic perspectives getting gloomier in view of upcoming pandemic waves. To start with, in the US, we have a shrinking shale industry marked by consecutive production shutdowns and financial challenges for independent drillers with thinner balance sheets. That could thwart Donald Trump administration's denial of any climate action. However, in case of a Democratic win in the upcoming US presidential election, it is the same situation that could facilitate the implementation of Joe Biden's extensive $2 trillion climate plan, who does not ban fracking altogether, because that would only be made possible through congressional action, but does block new fracking on federal lands and establishes aggressive methane pollution limits for new and existing oil and gas operations. According to the US Energy Information Administration, COVID-19 will lower US energy-related CO2 emissions by 7.5%. In 2019, US annual energy consumption from renewables exceeded coal consumption for the first time since 1885, while Wood Mackenzie projects an 18 gigawatt of new PV capacity and 1.2 gigawatt of storage capacity to be installed in 2020, both record volumes, as climate action is actively being promoted under the state rather than the administration auspices. Here it is also important to note that gas is expected to hold a non-negligible 40% share in US electric power sector generation, once again according to the US EIA. Of course, the complete phase out of fossil fuels, as the climate activist movement suggests, seems rather impossible, because shale oil and its gas subsector will likely be largely consolidated by IOCs willing to invest in short cycle supply. That is, supply that can be quickly brought on and offline in response to global oil prices, in contrast with the longer lead times required for conventional projects. Still, the revival of the long-stalled Green Deal could now stand a better chance as part of a post-COVID-19 recovery package, depending on the election outcome. At the other side of the spectrum, the EU member states are now actively discussing a 50 to 55% greenhouse gas emissions reduction target, with the aim of achieving climate neutrality by 2050. It is this framework of the European Green Deal, presented by the new European Commission late last year, that holds implications for European Union's fossil fuel consumption. We have a series of policy and regulatory tools, such as the still in the making gas decarbonization package, which is going to affect the future of unabated gas and its associated infrastructure, the green finance taxonomy, which is a common classification scheme for sustainable investments, and of course the revision of the Trans-European Energy Networks Regulation of 2013, in the process of which much debate has been generated over the future of gas and oil networks, with the latter never being prominent on any project of common interest list and excluded from funding under the Connecting Europe facility. So all these regulatory and policy tools will give Europe a greater sense of direction regarding its medium and long-term exposure to fossil fuels. Despite occasional calls, especially by the coal-dependent Visegrad Group, to scrap the EU Green Deal and to focus on eliminating COVID-19 instead, the EU did put climate action at the heart of its post-COVID-19 recovery program, with measures such as an overall climate target of 30% applying to the total amount of expenditure from the multi-annual financial framework, that is the EU budgets for 2021-2027, and the Next Generation EU, that is the new recovery instrument. However, with the Just Transition Fund, aimed at supporting those regions most affected by the transition to a low-carbon economy, having been slashed from the Commission's proposed 40 billion euros to 17.5 billion euros, this means that priorities should from now on be placed on the so-called coal regions in transition in terms of the apportionment of EU structural and cohesion funds. According to ENTSO-E, throughout March and April 2020, the peak months of the lockdown, European renewable generation soared at the expense of coal and gas, which went both down by 17% and 35% and by 5% and 24% for each month respectively. Overall, in the first half of 2020, renewables generated 40% of the EU27's electricity, while fossil fuels generated 34%, according to ENTSO-E data processed by Amber. Regardless of it being historically more oil-intensive than Western Europe and always depending on the outcome of the upcoming presidential election, the US could follow suit, setting up similar strategies to salvage a viable energy transition based on sustainable regulatory principles. Falling renewable costs could moreover incentivize further progress with China's national and multilateral clean energy initiatives. According to its energy revolution strategy, the non-fossil fuel share in China's energy mix should account for 15% in 2020 and 20% in 2030. Green energy cooperation is also foreseen on the international and regional fronts as part of the Belt and Road Initiative and the Association of Southeast Asian Nations EU Action Plan. However, lower for longer prices will likely hinder China's attempts to move beyond coal and to prone emissions through, for example, the development of its EV industry. Although here it should be borne in mind that retail gasoline and diesel prices are not adjusted downwards whenever oil prices fall below $40 per barrel in order to limit losses at China's NOCs. With the market momentum having been reversed from the minus 40s to 40s plus, China is already helping to take excess crude off the market, having purchased some 3 million barrels per day in excess of their internal demand in June. On the positive side, lower for longer prices will likely encourage a broader coal to gas switch, as spreads between long-term oil indexed contracts and spot LNG contracts has been reduced, although this could also put Chinese investments in prospective pipeline infrastructure from Central Asia and Russia at risk. It is for the same reason that a key growth market like India could allow for LNG to make inroads against coal. However, the lockdown imposed by Prime Minister Narendra Modi on March 24th could hold implications for its renewables-based clean energy plan. According to its national determined contribution under the Paris Agreement, India should achieve a 40% of non-fossil fuel power generation capacity by 2030 and a 33 to 35% reduction of its GDP's emission intensity from the 2005 level. The government thus pledged to 175 gigawatts of renewable capacity by 2022 and 450 gigawatts by 2030. Now, the halt in construction and tendering out of renewable capacity because of the lockdowns and the associated economic recession will now likely defer these goals. And finally, the Middle East and North Africa region, where primary energy mix is one of the most fossil fuel-centric ones internationally, and where large-scale production and exports of oil and gas provide vital income to finance national budgets, and thus any kind of volatility in global energy markets almost instantly translates into macroeconomic pressure. So this region is likely to see renewables not winning from the current oil crisis. Similarly, with other economic sectors, renewable investments are highly contingent on direct and indirect government support due to the modest private sector penetration in the region. However, lower for longer prices could help the region diversify from the so-called resource curse and could also help it remove controversial energy subsidies that to this day constitute a crucial social safety net. If reforms do not evaporate the moment prices recover, the Middle East and North Africa region will manage to prove its low-cost producer status as oil demand peaks, and will manage to shield its economies from oil market volatility with counter-cyclical fiscal policies. Therefore, low oil prices are unlikely to spur individual state climate action. That is because the integration of low carbon sources and the electrification of the system through, for example, the widespread adoption of EVs necessitates spending that the coronavirus hit world economies will struggle to afford. That is even more the case with the resource-driven Middle East and North Africa states whose budgets depend upon OPEC output regulation decisions. Others, like China and India, will take advantage of low oil prices with uncertain effects, with uncertain implications for their clean energy strategies, although this could also promote a systematic coal to gas switch. Countries with steadily negative opinions of the fossil fuel industry and its carbon footprint, like the European Union member states, are better positioned to keep the climate action momentum strong. And finally, the discussion surrounding a Green New Deal, particularly following the negative WTI prices, remains questionable and could either be abandoned altogether or resumed in a modified form, depending on the outcome of the upcoming election. But what about collective climate action? Well, The coronavirus economic crunch will likely jeopardize multilateralism, an essential element to meet the climate challenge on the international scene, and will instead foster isolationism and unilateralism. Despite that, the oil downturn could present an opportunity for world governments to kind of introduce an increased fossil fuel taxation, because at the present price lows, taxes will not hurt consumers and will instead boost budget revenues in favor of climate funding. The EU is actively moving towards that direction with the introduction of greenhouse gas border taxes, which are going to make its gas imports with high methane emissions in the value chain or without independent certifications of these emissions rather problematic. Now, the second section of this presentation will discuss the outlook for the fossil fuel industry at both the IOC and NOC levels against a peak oil demand backdrop. Second quarter earnings showed both the majors and publicly quoted firms reporting losses and thus writing down assets and cutting capex for 2021 in a bid to shore up their balance sheets. The emission declines and the declines in fossil fuel use mentioned in the previous section did raise ambitions that the need to respond to COVID-19 could accelerate the development of corporate climate action models, although it is easily possible to claim the opposite, because the unprecedented economic contraction gave humanity a glimpse of its over-reliance on fossil fuels, as well as of the political and economic rigor needed to meet Paris targets. Now, these realizations encourage IOCs to adapt their investment choices to the pace of the energy transition. In order for IOCs to become attractive, they have to return money to their shareholders through dividends and buyback programs, a project made all the more difficult now that low oil prices reduce their profitability, as well as the commercial appeal of fossil fuel projects versus renewables. Now, from an economic standpoint, oil price volatility accentuates the intrinsic risk factor of fossil fuel investments. A bit more modest, low carbon project returns are more predictable and bankable. In short, they offer lower risks and stable cash flows. Now, the US-EU company approaches again differ. The European energy firms clearly abide by the Green Deal roadmap. Indicatively, from February to May 2020, BP, Eni, Shell, Total have all pledged to go carbon neutral by 2050. Now, pressured by society and investors, US firms, including the likes of Exxon, Chevron, Conoco, and Oxy, participate in global climate diplomacy as members of the Voluntary Oil and Gas Climate Initiative and the Climate Leadership Council. However, they lack the domestic policy incentives, like, for example, climate-focused government stimulus packages, through which their European counterparts support their businesses. In the meantime, we've also witnessed activity of the sort of Chevron's, for example, after the purchase of Noble, the announcements about production increases within the neutral zone and the exploration MOU covering southern Iraq that basically indicate that while their European counterparts remain focused on net zero, US firms take advantage of the price crash in order to gain cheap access to quality conventional reserves, indifferent of the fact that this production will likely still be years away, by which time it might have turned into a bunch of stranded assets. Now, as the CEOs of BP and Vitol recently stated, oil demand might be nearing its peak, with nearly 1/3 of it eradicated by COVID-19, as big oil tries to self-determine in an environment where climate change gains more and more political visibility. Now, back in the beginning of the 21st century, the concept of peak oil involved fears about poor innovation in production and a dearth of new extraction sites. However, after the second tremendous price crash since the 2014-2016 period, the perspective of this theory has shifted from peak supply to peak demand. The industry economics are particularly important here. Although fossil fuel divestments have so far been mostly limited to coal, peak oil might extend them to oil and gas. However, in the meantime, it might advance the majors' natural gas portfolios in order to address solar and wind's intermittency issues. As of late 2019, spot gas prices have gone down, mainly due to successive unseasonably mild northern hemisphere winters. Furthermore, the currently low oil prices could be beneficial for buyers of long-term contracts, albeit with a 6 to 9 months lag, while producers could assess the viability of new capacity at lower oil-linked prices later on in 2020. Therefore, we might end up with a more flexible and liquid LNG market, thanks to which coal could be displaced in both Europe and Asia, also taking into account the value of gas storage for the system integration of renewables. However, small interregional price differentials that leave very little room for arbitrage gains from moving LNG from region to region might dissuade IOCs from new project investment, as the returns from switching gas between markets decline. Portfolio players with large balance sheets are more likely to pull off such projects without relying on external finance. However, IOCs already witnessing low project returns on LNG projects in their fleet for the past decade or so are unlikely to give similar investments another go. And finally, regarding the sort of climate compliant investments in their gas portfolios, those favoring sector coupling like blue hydrogen projects, well, these still lack mature markets where capital would be quickly and massively allocated and absorbed. But what about IOC's strictly renewable portfolios? The fossil fuel industry currently represents about 2% of global investment in renewables, while their cash flow generation and carbon mitigation strategies require an oil price range of $50 to $60 per barrel. Within this range, solar and wind assets with an average IRR of 5 to 10%, which is 12 to 14% for offshore projects, cannot compete with the average 20% IRR of an oil drilling project, although this project, as we said before, involves risk. You might not get the flow that you want. However, with oil in the 20s to 30s range, oil project returns are pretty much equal with returns from low-risk solar and wind projects. In this low price environment, cheaper renewable costs imply that renewable projects can avoid subsidization and can yield stable cash flows under long-term supply contracts, basically being on par with greenfield oil projects. What has been said about IOCs is even harder to apply to NOCs, who generally stick with their respective governments' priorities and try to enhance regional integration through the oil and gas value chain, as their very mission is to increase the state's cash flow through tax proceeds, dividends, or borrowings. The fact that NOCs traditionally benefit from very low production costs do not let them realize the very deflationary nature of renewables. For instance, Aramco's average upstream capital expenditure for 2018 was $4.7 per barrel of oil equivalent, which was lower than that of all 5 major IOCs. Over time, even the cheapest oil producers are going to struggle to compete with a deflationary energy source, as this source becomes more large scale and thus a lot less expensive. In line with what was already mentioned in the previous section about the Middle East and North Africa region, as long as these governments perceive the oil price slump to be a circumstantial, a kind of cyclical phenomenon, something that could be overturned, then the harder it will be for NOCs to undergo thorough overhauls. Now, there are three different levers for expense cuts in order for both IOCs and NOCs to respond to low oil prices. Number one, defer new project final investment decisions, perhaps with the exception of quicker earnings shale. Number two, boost efficiency in their existing operations. That is to try to achieve equal production by spending less. And number three, minimize activity and costs in their base business. And that includes short cycle investments, exploration, and operating costs. Now, IOCs and NOCs' strictly low and zero carbon investments will depend on the climate policies and regulations to be implemented by NOCs' respective governments and by IOCs' host governments, in order for the latter not to lose their social license to operate. However, low oil prices will likely increase the quantity and pace of the industry's clean energy investment options. Now, the big question has to do with companies' medium-term expectations. If they believe that prices could rebound to the 60s, 70s range within the next decade or so, then spending on future drilling does make economic sense. However, if they foresee peak oil demand by 2030, then they will have to continue diversifying their portfolios. And in that case, investing in renewables looks proportionally more attractive. Now, the problem is that the current price lows have hit companies' oil and gas profits, and that was supposed to be the pool of revenues from where energy transition assets would be financed. So the level of these profits in the medium term will determine both firms and their shareholders' stance towards climate. Now, to conclude, lower for longer prices will induce only modest individual state climate action for very different reasons per country or per region, with the exception of the European Union, which will stick with its Green Deal roadmap. Moreover, the COVID-related economic distress will likely undermine multilateralism in global climate diplomacy. However, concerted solutions like a consumer-friendly fossil fuel taxation that will strengthen international climate finance can always be worked out. As for the industry, the reformulation of peak oil theory, with the focus being shifted from peak supply to peak demand, will now most probably make IOCs more determined to pursue clean energy initiatives. New gas project final investment decisions, considering the role of gas as a bridge fuel to renewables, seem doubtful, because in a market where steadily low oil prices eradicate differentials between regions, companies may be less incentivized to continue with this portfolio approach, as the returns from switching gas between markets decline. As for renewables, if oil trading falls back within the 20s to 30s range, then cash flows can be generated. However, the level of such investment remains contingent upon the climate policies and regulations to be implemented by NOC's respective governments and IOC's host governments, which explains why the state and industry levels are distinct, but still mutually reinforcing. Whether or not the oil collapse will offer renewable energy its catalytic moment depends on the degree of its recovery to pre-pandemic highs. But it is a fact that the positive worldwide emissions and fossil fuel abstention figures that we mentioned before have at least opened the debate on a possible long-lasting impact of the oil market downturn on climate. It is important to note here, from an energy security perspective, that during the peak of the pandemic, especially in Europe, the flexibility of the system was put to the test, and transmission system operators succeeded in balancing supply and demand in a very different way than they were used to. That is, by managing higher shares of variable renewable energy into the grid, especially in a very windy period for Europe. Now, the same debate will also raise the issue of how interstate power relationships are going to unfold in a clean energy world. Historically, far-reaching energy market shifts have been accompanied by geopolitical shifts. For example, the coal to oil transition made relations with the Middle East and the Gulf geopolitically indispensable for almost every nation's energy security. Moreover, the shale revolution of the past decade that expanded the geopolitical clout of the United States thanks to its nascent oil exporter status serves as another yet example of such a shift. However, the situation is now rapidly changing. And by that, I mean that the growth of decentralized technologies imply that the future energy systems will stand out for high-level competition and the absence of energy superpowers emerging from them. Now, the gain-loss game about geopolitical advantages from the energy transition might even turn traditional hydrocarbon producers like Russia and Saudi Arabia into holders of stranded assets. So as low oil prices suddenly render renewables as attractive as upstream projects, I'd suggest that the geopolitics of the energy transition deserve greater attention. And that would be pretty much all from me. Thank you very much. Roberto, back to you. And now I can stop sharing my screen.
Great. Thank you, Mariana. That was a very informative and comprehensive presentation based on your work. So now we move everybody to the question and answer period. So please keep your questions coming and I'll then read them out loud and we will try to answer them. Question for you, Mariana. Going back to North America and the shale industry, in what way is the foreseen consolidation in the US shale going to drive IOC's diversification into lower carbon assets, renewables in the long run, provided that climate change is recognized as a policy priority by the US administration?
Well, yeah, as said during my presentation, US IOCs currently lack the policy incentives through which their European counterparts support their own businesses. However, they have grown skeptical about challenging and costly upstream projects, and by that I mean deepwater and offshore fields, as well as midstream projects. And by that I mean undersea, subsea, long-distance pipelines. Therefore, they try to focus their spending on quicker earning investments at home. And we saw that, for example, by the examples of Exxon's divestments from the Black Sea and Chevron's divestments from the Caspian Sea earlier this year and in 2019 as well. So that's on the one hand. And on the other hand, we have the grim financial position of independent drillers, which were the ones that incited the US shale revolution some 10 years ago. So their grim position will lead into a larger consolidation for the sector. And this is exactly where the much deeper pockets of the Chevrons and Exxons are going to get in and fill the gap and bring back production as soon as prices recover, and further invest in the digitalization of the sector and the automation of rigs. Therefore, we have US IOCs responding to shareholder demands about financial discipline, about more attractive project returns, about the abandonment of projects, on the other hand, with marginal economics due to the low oil price environment. And this attitude, it is precisely this attitude that, although it is not necessarily climate driven, could help them generate the quickest possible cash flows that would finance the diversification of their portfolios into low and zero carbon assets, provided that climate change is also recognized as an administration priority at a certain point.
Mm-hmm. Mm-hmm. Interesting. And some of what you said about short cycle projects applies to gas and LNG in the part of the world where I'm located in Australia, the past decade saw hundreds of billions of dollars of investment into these very huge capital intensive projects. But then prices crashed and the industry has entered into a much weaker market than anticipated. So now they're doing these kinds of things to reduce costs, things like standardization of equipment, sharing of infrastructure, and the introduction of smaller, flexible technologies like floating LNG, for example, which is much simpler and less costly than the massive projects of recent years. Also on the consumption side, that floating LNG import infrastructure is being considered in many parts of the world. In particular, it enables less developed countries who don't have the financial scale to construct these massive onshore import facilities the opportunity to increase their natural gas usage as well. So we have a question here, David Sword. It's about Canada's oil sands. And what are your thoughts on that region's ability to be a provider of choice for world oil markets? Thank you. Perhaps I can give my view on that.
Yeah,
First of all,
I think that's for you to reply. Yeah.
Sure, because I was born in Quebec but raised in Alberta. And speaking of massive projects, oil sands are of course very capital intensive projects with lots of momentum behind them. They have their eye on the very long term, and so they don't become overly concerned with short-term market challenges like we've seen this year, for example. So they will be expecting that oil consumption will rise over the long term, especially now as economic growth keeps rising around the world. And therefore, these projects, they keep producing. A lot of the time, they're so technically challenging to stop, to shut down when prices crash, that they choose to operate at a loss for a while, and they have the expectation that prices will rise in the future. In addition, sometimes they have to keep going. Maybe they have legal or regulatory requirements to do so. But I agree with most authoritative forecasts that see oil sands production rising over the long run. The rate of growth has probably slowed down over the past decade because there has not been as much investment as there had been during those years of high prices in the first half of the past decade. So I do believe oil sands will keep up. It will depend to a large degree on midterm infrastructure. That's a domestic issue within Canada. There has been a lack of pipeline capacity, which means that often that market is oversupplied, and therefore the prices of crude from the oil sands trade at a steep discount to other benchmarks in North America. But pipeline capacity is being slowly expanded, which will offer relief to that industry. So Mariana, going back then to energy transition and what you covered in your presentation, you mentioned deflation, inflation. Could you elaborate a bit on what is meant by the deflationary aspect of renewable energy projects as opposed to the inflationary one for the fossil fuels?
Yeah, absolutely. In fact, the deflationary aspect of renewable energy projects is, in my opinion, most probably the most underestimated aspect of the entire energy transition narrative. So let's see, fossil fuels are by their very nature inflationary. And what does that mean? You have to go out and you have to dig for and explore for and drill for the cheapest sources of supply. However, once those sources become depleted, you have to go out again, and this time look for more expensive sources. Whereas with renewables, it's the exact opposite. You start from an energy source which is relatively expensive, of course, because it is underdeveloped technically, and then you create economies of scale, and then your technologies improve, and in the end, you kind of end up with a set of infrastructures that have been designed to capture energy that is already there. And if the short-run marginal costs are zero, which is the case with both wind and solar, and as long as infrastructure costs fall, which they continue to do so, then you end up with a very deflationary impact. So that's the idea, that's the concept.
Very good. Another question for you, Mariana, because I had trouble wrapping my head around why oil price crash would somehow accelerate an energy transition, especially when economies have been devastated, people are out of work, debt is very high, investment is faltering. But so my question is from an oil consumption side, don't low oil prices give it a competitive advantage and therefore make renewables more expensive since they'll require greater subsidies as a consequence of the low oil price?
Well, yeah, of course. The thing is that the present oil collapse has sort of coincided with a period of falling renewable costs. Now, these falling costs could be attributed to policies such as tax credits, such as preferential feed-in tariffs, such as renewable portfolio standards that directly target the use of renewables, expand demand, and develop cost-reducing economies of scale to meet that demand. They can, of course, also be attributed to manufacturing efficiencies, which have significantly, for example, lowered the costs of solar PV projects in China. Therefore, as I said in my presentation, these continuously falling renewable costs will make those projects sort of avoid large-scale subsidization, as they will be able to yield stable cash flows under long-term supply contracts, basically being in part with greenfield oil projects. Now, on the front of consumption that you just spoke about, it would be interesting to watch, perhaps towards the end of this year or the start of the following year, how the oil consumption versus renewables consumption might have gone. Because in countries like, all over the world, the infrastructure and the contractual framework for oil is already there. Whereas renewables are a concept which is kind of still in the making, even though it could be more easily promoted at this stage because of the regions I just mentioned. The policies I just mentioned, yeah.
Right. And speaking of costs, from the oil industry's point of view, it will also be important to include costs in their overall economic evaluations. Going back to the oil sands question, that industry is sometimes perceived as being carbon intensive, dirty. So, their future prospects depended on the ability to implement clean technologies and to include environmental costs in their investment plans. So it's an important thing to keep in mind as well. I want to also ask Mariana, despite the narrative around this energy transition, especially during the pandemic, can you comment further on possible political inhibitions to actually implement climate policies due to their high costs? We've seen in several countries that policies like carbon taxes, for example, can be unpopular. So yeah, political inhibitions despite the narrative from politicians. Can you comment?
Yeah, so getting to the actual implementation of climate policies is certainly going to prove a tricky task and is certainly going to impact the popularity of political parties currently in office. However, the political success of the implementation of such policies will depend upon how solid the foundations of these policies are already from now. And this is where it would be nice to mention the example of the European Union, which has already led such solid foundations, because the EU has already created concrete strategies for the 2030s and the 2050s horizons. Now, as you said, even in countries that are not low-income countries like the EU countries, there are certain policies that the climate change policy framework would involve that could be unpopular, like the carbon border taxes, which in the case of the EU would make its fossil fuel imports rather problematic. Now, the problem with a carbon border tax policy, in my opinion, is the price level, because the price has to be just right. Because if it's too low, then you just end up with a modest cost, which will be absorbed in final prices and will have no major decarbonization impact whatsoever. On the contrary, if the price is too high, then you kind of end up with a two-sided world. You have a low carbon world and a high carbon world, and absolutely no trading activity between them, or very limited trading activity between them. So you kind of disturb the world trading order.
Okay, great. I think we have time for one more question, then we'll close the webinar. And Mariana, it's about a very popular topic in recent years, and that is hydrogen. Can you, in general, briefly comment on the role of hydrogen in energy transition? What are the prospects for the future?
Well, hydrogen is going to be that aspect of the energy transition narrative that will sort of make the fossil fuel industry survive. Because hydrogen projects, especially blue hydrogen projects, that are going to be implemented in the medium term in order to get to green hydrogen projects in the longer term after 2030, at least in what concerns Europe, are going to use a large part of the already existing gas infrastructure, pipeline infrastructure, and storage infrastructure. So if the fossil fuel industry has one chance to sort of maintain its social license to operate in a climate neutral world, then hydrogen will certainly give this opportunity to the industry.
Yeah, absolutely. I agree about the synergies there, and I see it as quite a long-term prospect, and that will be one in a group of sustainable resources in the very long term. But we are out of time, so that concludes the webinar. I'd like to thank the IAEE again. Thank you, Mariana, for the excellent presentation. Thanks to the audience for your attendance and participation, and hope to see you at a future IAEE conference in the near future. Let's hope. With that, we throw it back to David Williams. Thanks, David.
Oh, thank you. Thank you, Roberto, for both your presentation and Mariana's. I really appreciated this. This is a topic we could talk about for certainly hours. And we're grateful for your time and your expertise here. For those listening, this webinar has been recorded, will be on our website this afternoon for rewind so that you can listen to it, pass it on to your friends and colleagues. A quick mention again about IAEE. We encourage you to join by visiting us at www.iaee.org. Wishing everyone a wonderful weekend. Thank you again. And I officially close this webinar. Bye now.
Thank you.
Thank you. Bye.